Hi, welcome back to Joe Blogs. And in today's episode, I want to talk to you about what's happening in the economy in China. But just before we get into that, if I could ask you to hit that subscriber button if you haven't done so already. If you've been watching my videos but you haven't subscribed, it doesn't cost you anything, but it makes me feel happier. And also, it makes my videos work better with the YouTube algorithm. So thank you very much for doing that. And in today's video, I want to give you an update as to what's happening in China because unfortunately, the results for July show that the Chinese economy is slumping even further. Two of the most important metrics for China are what's going on with regards to industrial output, so the manufacturing side of China, and what's happening with the property sector. And as you can see from this graph, industrial production fell to its lowest growth rate for the past 8 months. And that represents serious problems for China going into the second half of 2025 because it set a very ambitious growth target of 5% for GDP. And there is now a huge question mark as to whether or not that's going to be achievable. And in terms of the property sector, we have seen the slump continuing. New home sales prices are down, sales are down, and investment into the sector is also down. And as property represents around 25% of total GDP and manufacturing represents more than 30%, China is in a really serious situation. So we will go through all of the charts in some detail later in the video. But before we get into that, I want to talk to you about today's sponsor, investing.com. I'm an active investor, and one of the things I like to do in all aspects of my life is research. I want to make sure that I've done as much research as possible before I put a cent of my own money into the markets. And investing.com provides one of the biggest databases you will find anywhere on the planet. But in addition to the amount of data that it has, it also offers you the opportunity to use artificial intelligence. Using its Pro Picks, it selects a variety of different shares every single month that it believes will do better than the market. Now, the latest Pro Picks were released at the beginning of August, and I invested into all of those for the tech sector. And since that time, my portfolio from those picks is up by 3.9%. And the standout investment was Viasat, which is up by 43% since the start of August. And the great news is that the summer sale has been extended, so you can get 50% off a subscription until the 28th of August. But in addition to that, you will also get a further 15% discount for being a Joe Blogs viewer. So if you're interested in that offer, please click in the link in the description below or scan the QR code on the screen now. Now, if you've been following the channel, you'll know that the Chinese economy has been struggling for some time. And one of the problems that China has is that it's struggling with its home market at the same time as its export markets have also been decimated by the tariffs that were announced by Donald Trump. And we're still in a period of negotiation in terms of what the final tariff is going to be on Chinese imports into the US market, which is the single biggest export market for China. But we start off by looking at what's happening in China itself. This chart shows the movement in the rate of inflation in China over the past 12 months. And the scale on the right-hand side here is quite interesting because it goes from 0.9% at the top to minus 1% at the bottom. So you can see that China hasn't really been seeing much inflation at all over the last 12 months. And in fact, in the past 6 months, it's been struggling with deflation. You can see that in February, year on year, prices actually fell by 0.7%, and they remained in negative territory in March, April, and May. There was a bounce back slightly in June when prices rose year on year by 0.1%, which is very, very small. But unfortunately for China, the results for July show that year on year there was 0% inflation. So that means that prices in July were exactly the same as they were in July 2024. Now, as a consumer, you might be thinking, well, that sounds like quite a good deal. I don't want to pay an increase in the price of anything. I'm quite happy for prices to stay stagnant. But the problem that this throws up is that if you're a company and you're seeing 0% inflation in your home market, then it's very difficult to pass on any cost increases. And we'll have a look at what's going on with producer prices in a moment. But if we now have a look at what's happening with food inflation, because it's something that we always like to touch upon when we're looking at inflation, you can see that the results for July actually show that year on year prices fell by 1.5%. And this was actually the sixth consecutive month of negative price falls in China. So if you're in the food industry in China, if you produce food, then you're seeing the price of that food actually going down year on the shelves, which is not great news because, as we just talked about, the producer prices, which are the factory gate prices in China, have now been falling for 3 years. And you can see that the results in July show that year on year, producer prices fell by 3.6%. So, what that means is that the price of your product is now 3.6% lower than it was this time last year. And of course, the issue with that is that the cost of things is actually rising. So we're seeing an increase in raw material prices, we're seeing increases in wages in China, we're seeing increases in rental prices. So if you own a factory, you have to pay more for the rent on that factory. So when all of your costs are going up, but your sales price is going down, that means that your profit margin is deteriorating. You're having to absorb your cost increases because you can't pass them on to consumers. And that's now becoming a major problem in China. And if we look at what's going on with retail sales, which is basically the amount that Chinese consumers are spending in the stores, you can see that the results for July show that year on year, retail sales were up by 3.7%, which in isolation might sound like quite a good result, 3.7% growth. But you always have to look at the trend. That's why I show you these graphs to see what trends are going on. And if you look at the trend, you can see that back in May, year on year, retail sales were up by almost 7%. But since May, we have seen a rapid deterioration in that growth. So if we were to extrapolate this, if we were to roll this trend forward for August, September, October, November, December through to the end of 2025, and it carries on doing what it's been doing for the last couple of months, we will see a continued reduction in the growth of those retail sales. And that's a major problem for China because it's only really got two options: either to sell products into China itself, the 1.4 billion people who live there. Now, I know there's a lot of conspiracies on the channel. Whenever I talk about 1.4 billion people in China, I get a lot of people saying there's only 800,000 people in China. Stop talking nonsense. But I'm going with the official data. So that's what I'm working with. So there are companies in China are either selling into the home market or they're selling into the export markets. They're the two options that they have. And if we have a look at what's been going on with exports, we can see that the trend since May is actually positive. We've got some increase in the growth in exports. And the figures for July showed that year on year, exports are up by 7.2%. So that's moving in the right direction for Chinese businesses. And if we have a look at what's going on with imports, which is also a really good indicator because China imports lots of raw materials, which it then uses in its manufacturing processes to make things, and then it exports them. So the level of imports gives us an indication as to what's likely to happen in the future because it tells us whether Chinese companies are importing more, if they're gearing up for more sales. And you can see that over the past 12 months, there's been a really interesting trend here. Since October 24, imports have actually been falling. We've seen year on year reductions in the amount that's being imported into China. And that was as a result of the fact that Chinese businesses were worried about what was happening with Donald Trump and the tariffs and all of those associated things. Now, since we've seen a stabilization in the tariffs, when Donald Trump announced the 90-day pause, and then there was a meeting between China and the USA where it was agreed that we would have a further pause period, so the 145% tariff was taken off the table. We've seen an improvement in the situation. So in June, we saw imports increasing slightly, and that situation has increased further in July, and we've seen around the 4.2% increase in imports. So the trend here is positive. But the problem that China has is that it's not out of the woods yet. It doesn't really know what the final situation is going to be with regards to the USA, its largest single export market. So companies are sort of increasing the amount that they're buying in. They're getting ready because they're hopeful, they're optimistic that things might improve. But as we've just discussed, the factory gate prices are still going down. And we saw that in July, there was a reduction of 3.6%. And that's the same as it was in June. And that's been going on for a long period of time now. So even though the total amount of exports is rising, the price that all of the companies are being paid for each of those products is going down. So their profit margins are falling. And it's been reported that over 50% of companies in China are now actually making losses. So they might still be selling things, they might be increasing the amount that they're exporting. But if you're not making any profit on any of those products, then that's not really going to be good for the long-term health of your company. And if we look at what's going on with the Purchasing Managers Index, which we've looked at many times before, this is basically a survey of all of the key people in Chinese companies. So these are the purchasing managers. They're the ones who are placing orders for all the raw materials. They're gearing up for future sales. And the key issue here is whether or not the PMI is above or below 50, because 50 is seen as a standstill point. So that means a company is neither expanding nor contracting. If you get a score above 50, it means you're expanding. Below 50 means you're contracting. So you're basically reducing in size the amount of business that you're doing. And the results for July are now in, and they show that the PMI came in at 49.3. So that's obviously below 50. And that tells us that companies in China are currently expecting to contract. And if we look at the scores here, you can see that the PMI has been below 50 in every single one of the last 4 months. It jumped up for a brief period in February, March, and it was below 50 in January as well. So out of the last 7 months, we've had 5 months below 50, and that tells us that Chinese businesses are still very cautious. They believe that there is trouble ahead in terms of what's happening with the level of trade. And obviously, that's linked to the tariffs in the USA, the volume of exports, and the margins that Chinese businesses are making. Now, as I mentioned at the start of today's video, one of the other major contributors to the Chinese economy is the housing market. And we've talked about that a lot over the past few years. Evergrande was the first big problem company in China. That was the company that had over $300 billion worth of debt. It's now bankrupt, illiquid, it's been broken up, it doesn't exist anymore. But the property market obviously still exists, and it's still struggling. And this chart shows the year-on-year movement in house prices in China. These are newly built house prices, which is the main benchmark because it still represents the majority of the market. Most people in China want to buy a new property rather than buying old properties. And you can see that year on year in July, house prices fell by just under 3%. And this was the 12th consecutive month that you can see in the last 12 months of house price falls. And in fact, house prices have now been falling for more than 2 years. And that's a problem because if you think about your own situation, if you were considering buying a property and house prices were constantly falling, new house prices were going down every single month, then you wouldn't really rush to buy a property because you'd be thinking, well, if I wait a little bit longer, another month, another 3 months, another 6 months, they'll probably be cheaper again. So why would I want to buy today and then go straight into negative equity? You don't want to buy a property for, say, $100,000 today, and for that property to be worth $99,000 next month, and $98,000 the month after, and $97,000 the month after that. You just sit back and wait for the market to bottom out. And that's what a lot of people in China are doing. A lot of consumers have lost confidence in the market because it's got this constantly falling sales price. And as a result of that, the value of new home sales is continuing to go down. This chart shows the year-on-year movement in new home sales. And you can see that it's down by more than 20% year on year. And in fact, when you look at the last 12 months, there have only been 3 months when the value of new home sales has increased. And those situations very quickly reversed. So that's not helping either because the market is contracting. And because of those factors, investment into the property market, so new money coming in to invest into infrastructure and to build new property and expand the amount of stock that's available, continues to go down. You can see that in July, year on year, property investment fell by 12%. And that was actually the biggest fall that's been seen at any point in the past 12 months. So nobody is seeing a reversal in the property market problems. They're not expecting things to suddenly become really healthy and for the property sector to start booming again. This is a long-term problem caused by oversupply, increasing prices, and then a lot of people becoming very disillusioned with the market. And so there are very few buyers who now want to come back into the game. A lot of people have had their fingers burned over the last few years. Now, one of the other problems in China that's now starting to emerge is unemployment. And the figures for July show that unemployment is now up to 5.2%. And that's the highest that we've seen since February. And if you look at the chart for the last 12 months, it's one of the highest rates. And once again, if we look at the trend here, obviously in June, it was at 5%. We've seen a 0.2% increase in 1 month. And if that trend continues, it's going to raise some major concerns in China because we've got 1.4 billion people. They need to find jobs. And if unemployment is rising, that means there's going to be more people out of work. That's going to put more pressure on the state to support those people. And so this represents a serious issue in terms of the general funding for the social services. And if we look at the number of employed people dating back to 2013, you can see that it's actually been in decline since 2016. And we've got a rapid decline in the current level, which is sitting at around 73.4 million people who are currently employed in China, is lower than it was in 2023. So we're seeing this constant reduction in the number of employed people. We're seeing an increase in unemployment. And all of this represents serious problems for the Chinese economy. We have a look at this chart, which shows the quarterly reported growth in GDP dating back to the middle of 2022. You can see that we've got a clear downward trend here. If you take a step back and look at the trend, back in the third quarter of 22, GDP was growing by 3.1%. The most recent data we've got for the second quarter of 25 shows that it only grew by 1.1%. So we've got a clear slowdown in the Chinese economy. And even though the last 4-quarter growth rate was published at 5.2%, which is above the target level of 5%, you can see that the majority of that growth came in the third quarter and the fourth quarter of 2024, when we saw 1.3% and 1.6% growth. In 2025, we've got real problems. It was only 1.2% in the first quarter and only 1.1% in the second quarter. And if you look at the trend again here, it's downward for the past 3 quarters. And even if China continues to deliver 1.1% growth in the third and fourth quarters of 2025, if it maintains the same level as the second quarter, then that would mean that it would seriously undershoot on its 5% GDP 12-month target. It would come in somewhere around 4.5%. But actually, if the trend continues, the reduction in GDP continues in the third and fourth quarters, then we could see GDP growth coming in closer to 4% for the full year of 2025. And that would represent a major problem for China because it's built everything on the assumption of hitting 5% GDP growth. But of course, when you've got problems in your biggest export market, as it has at the moment for the USA, it doesn't really know where those tariffs are going to shake out. But even if they come out at the 30% level that's currently in place, all Chinese products are now 30% more expensive than they were before Donald Trump took over as the president. That's going to lead to a reduction in demand, a reduction in sales, at a time when Chinese businesses are already on their knees in terms of their producer prices and their profit margins. So all of this represents serious bad news for the Chinese economy in 2025. So what's the summary and conclusion today? Well, I wanted to post this video because we've been following what's been happening in China, and it's a really important economy for the global economy because it's the second largest after the USA. So every economy in the world interacts with China, whether it be buying lots of the products that they're manufacturing or exporting things to China, because Western companies do export things into the Chinese market. So China holds a very important position in the global supply chain. And what we've seen in today's video is that the problems in China are persisting, and actually they're getting worse. The Chinese economy is dependent on two main sectors: manufacturing and property. Now, we've talked about property for a long time, and it's been in the toilet for the last few years as a result of the fact of lots of Chinese businesses over leveraging, taking on too much debt, over trading in terms of taking on too much new business. They were agreeing to build hundreds of thousands of new apartments, and they couldn't deliver on the build on all of those apartments. And lots of Chinese consumers have now been left with a situation where they haven't been given their apartment, but they've actually either paid a deposit, or in some cases they've paid in full for those apartments. They've taken on mortgages in advance of the build, and they're now sitting paying those mortgages for apartments that don't actually exist. And lots of Chinese property development companies have gone bankrupt. They found themselves illiquid. They don't have enough money to continue trading, and the government has been bailing out lots of those companies. It's been going around buying up the stock and the unfinished apartments and has been trying to finish those builds. So the property sector is shot, and as we've seen in today's video, prices are continuing to fall, new home sales are continuing to fall, property investment is continuing to fall, and so there is not going to be a silver bullet that is going to save that sector anytime soon. It's going to be in trouble for the foreseeable future. So China now is reliant upon manufacturing. It needs all of its businesses that are making things to come and save the day. But as we've seen, the manufacturing sector is also in deep trouble. We've seen a continued fall in producer prices. So companies in China are struggling to be able to increase their prices, which means that they can't pass on any cost increases. So they're having to absorb raw material price increases, wage increase, rent increases. All of those things have been going up at the same time as sales prices have been going down. And this is now being made worse by the tariffs in the USA, the biggest single export market, because Chinese companies are having to absorb some of the cost increase from those tariffs to try to remain competitive in the US market. So Chinese businesses are being hit hard at the moment, and so they're struggling to achieve the level of exports that they did historically. But also, added on top of that, they're struggling with the home market because China continues to struggle with deflation. There is no price increase being passed on through to consumers at the moment. And so Chinese businesses are in a world of pain, whereby their profit margins have been wiped out, and over 50% of Chinese companies are not making any profit. So their only option is to go to the banks, take on more debt to cover their losses, and that's increasing the leverage, increasing the risk. And we've got a bubble that's now starting to build in terms of the amount of debt that these manufacturing companies have on their balance sheets. And that's exactly the situation that we saw in the property sector, which ultimately led to the failure of lots of Chinese property businesses. So the longer that this problem goes on in China, the more problems are going to build for these companies. And at some point, we could see all of these businesses starting to go bust. Or the only other option is for the Chinese state to step in and bail them out. But of course, the Chinese state will only be able to do that by raising more debt itself. So it's putting China as an economy and a country into more difficulty. So the overall summary of today's video is that the data that we've seen coming out for July shows that the Chinese economy is continuing to struggle. There are major problems with the property sector, major problems with manufacturing, and we're now starting to see the GDP figures being affected. There is a huge question mark as to whether or not China can achieve 5% growth for 2025. And if it doesn't, that means that there will be an increase in debt, which is further raising the question as to what's going to happen to that debt in the future. So hopefully you've enjoyed today's episode. You found it useful, informative, and thought-provoking. If you've liked what I've said, then please smash that subscriber button, hit the like for this video, and if you want to support the channel, then please have a look at either Buy Me a Coffee or YouTube Super Thanks, or maybe consider signing up as a patron or a YouTube member or a Buy Me a Coffee member. Thank you so much for watching this video through to the end, and here's something to put a smile on your face.